going to be hosting an incredibly relevant panel that builds on a few of the things Lynn said. And I want to mention that. Lynn said two things that I thought were really important. On a fundamental level, it sounds trite, but how does your business make money? I think this is the number one impediment to our topic coming up, which is marketing attribution, because the CFO and the CEO of the business do not understand the math of the growth. And we're going to talk about the role of media in creating value and making money. I think that's fundamental. I'm just filibustering up here to you. Here's the challenge. I'm on the left. Second, she said something important. I liked her comments about systems thinking and connecting the dots across channels, stages of the revenue cycle, silos to create value. And I think that is a fundamental attribution and measurement challenge that we're going to be talking about today. And in particular, I've got three incredible experts who are creating models and metrics and workarounds. I like that, some frog DNA spliced in here that measure attribution in an incredibly complex world of many channels, many stages, B2B2C models. One of our panelists can't even see his customers because they're on private platforms. So I think that is amazing. And so to make the transition, I think, attribution is critical, because if we're unable as marketers, and in particular media, to connect what we do to value creation, it creates all sorts of problems in the business, lack of investment, inadequate budgets, low morale, poor allocation of media. And I had mentioned I'm a little bit passionate about this. Not only have I written this book where we put the equation for growing a business in chapter 10, it's called the revenue value chain, and it's guaranteed to get you more budget. But also, I ran the Forbes Marketing Accountability Initiative. I've written a report called Marketing Accountability, Proving the Financial Impact of Marketing. I've written a report with the A&A called Proving the Value of the Brand. So I'm like Don Quixote out here tilting at windmills, trying to go to CFOs and say, media has value. But our panel here today is going to talk about the challenges of measuring value in a rapidly evolving, changing customer behavior, an evolving mix of channels, a complex mix of channels, and demonstrating value, optimizing the mix, allocating resources, maximizing the business impact of media. And so without further ado, I'd like our panelists to introduce themselves in the context of their unique go-to-market model. And I think it's really interesting. We've got many different go-to-market models, the audiences you serve, and in general, how your business makes money. So I guess we'll go left to right, Emily, if that's okay.
Yeah, that sounds great. Nice to meet you all. I'm Emily Childers. I lead growth marketing at Credit Karma. Who in the room knows Credit Karma? Oh, yeah.
Oh, wow.
Who in the room uses Credit Karma? Less hands. Hey, we've got more products and services for a prime consumer, just saying. One-to-one marketing here. So we have over 140 million members. You saw those hands. We have pretty good market penetration. And we're pretty established for our 15-year run. We have really good saturation in the market, and a really big problem to solve, because we think that everyone is our customer. So that's a really interesting marketing problem for me to solve. And for folks that don't know our business model, we're actually an affiliate platform, meaning we bring in customers, members, on a free credit score or improve your finances message. They join for free, and we make money when they take out a financial product with one of our partners. So lots of folks here probably know the credit card affiliate model. It's quite profitable. That's where the majority of our revenue comes from, is loans and credit cards. So we do have a little bit of a B2B2C system going on, but the B2B side we handle in one-to-one partnerships with those large financial institutions. So I'm going to focus really on that B2C interaction and engagement. So we have a lot of problems, and we're going to get into attribution and how we think about that. But as the head of growth marketing, a performance marketer, one of my big problems right now is stretching out the funnel. Lynn talked about this, of taking it from brand all the way down to demand. So that's one thing we're trying to solve. And then the second, always, is incrementality. How do you know that your marketing is working? that if you actually didn't send that email, would you still have gotten that conversion? Would you still have gotten that new acquisition if you hadn't run that banner ad? That's always the existential problem for us. So I'm going to talk later about some of our methods and methodologies and some of the problems we're trying to solve right now. I don't want to hog the floor.
Why don't you jump in?
Sure,
You've got
of
some
course.
interesting stuff going on.
Hi, everybody. I'm Andy O'Rourke. I'm with Direction. For those that don't know, I don't want to do the raise your hand thing.
Sorry.
We're a little less known, but we are a provider of exchange-traded funds and some mutual funds. Within that world, emerging world of exchange-traded funds, we're a niche little corner of it where we primarily focus on what's known as leveraged and inverse ETFs. So these are high risk, high volatility funds that are used primarily for people who are thinking with a short-term mindset on the marketplace. So they're wondering what's going to happen today, maybe this week, and trying to make some plays trading in the marketplace using these products because they give you a little speedier vehicle to try to implement your conviction on the marketplace. Our audience is active traders. So what's an active trader? They really come in all shapes and sizes. It's anything from an institutional money manager that's managing large funds and are looking to use products like that as short-term implements within their products themselves. They're very popular with hedge funds who are implementing, again, riskier strategies for their more aggressive customers. But they're also used by a lot of self-directed traders, investors. And that is a big portion of our focus, and I'll probably spend most of my time today talking about that segment because I find it most unique. I'll talk a little bit about what it means to market to active traders, what their mindset is. Not that that's probably important to so many of you in the room, but I think more to the point of understanding how we recognize the mindset and adapted our program to try to make sure we're not just doing general market activities that might not apply to that short-term thinking audience, but how we focus primarily on those sort of news-driven, market-driven activities and try to jump on those opportunities in real time. It's challenging in the world of financial services. We all know about the challenges of getting content and creative, et cetera, through compliance. So it's not like I can have an idea this morning and implement it this afternoon, but we do try to think about what's going to happen over the next several weeks, couple of months, what's going to be prevailing of the areas that we're going to focus on and build our programs around that. But it's a little less of building a set it and forget it kind of marketing program because things do move a lot really fast in our world. And the last thing I'll say is it's a very product-centric, individual product-centric campaign. Traders of ETFs, as a marketing guy, I should never say this, but they care a little less about brand. They care about what's the fund. We do a lot of what we call ticker marketing in the ETF space. What's the ticker of the fund? That's what has to be left in someone's mind after they see whatever impression it is that you put in front of them. So we do a lot of that, and then makes it even more challenging in our attribution because now we're looking at product level attribution, which is it's actually the ability to do it is there. It's just a lot more work because we have over 80 products. So anyway, I'll let.
Although I want to say a spicy thing here.
Okay.
You say that traders don't care about brand. They say they don't care about brand. I still think they're impacted by it.
I do too.
Okay.
I don't want to be absolute about it. They do care, but they care more about whether there's a product that they can use today to implement their strategy.
Totally fair.
Good morning, everyone. My name's Jeff Kogan. I am here representing Hartford Funds. We are the mutual fund and ETF arm of the Hartford Financial Services Company. We market our products through firms like Lynn's, Northwestern Mutual. So we are a B2B2C model focused on financial advisors. While our mission is securing the future for our end investor, that is all done through the approximately 300,000 financial advisors across the country. That is our audience. So as we think about marketing, we're engaging with them. We do very little that would be considered kind of end consumer marketing. We're trying to provide them some value. Often it is product-based, right? But often it is more focused on other things that we do as a marketing organization, value add that we can provide to educate them about the markets, about how to grow their business, or other things like that. Our model from a marketing perspective is, from a paid perspective, we do a wide range of activities. Paid social is huge for us. We love the ability to target through our advertising. From an earned perspective, PR is very big. Getting out and talking about the markets, particularly on weeks like this, are very fruitful for us. And then, email is huge. We do a lot of email with financial advisors. We have a kind of robust program to do that. So measuring all those things is difficult, especially when combined with the nature of our business, which is our best prospect is our best customer. Someone who's already doing business with us, unless we have 100% share of wallet with them, we are going back to them not only on mutual funds and ETFs they've already done business with us on, but also can we cross-sell? Do they own us for equity and now we're fixed income? So when you think about attribution, the topic for today, it's really about, which email was responsible for those things? And it gets very complex, which is why we took a relatively complicated approach to get to some answers around that.
Well, let's zero in on specific attribution problems. This panel is a poster child or a cautionary tale, whichever way you choose to do it, of a cavalcade of common modern attribution problems. Flying blind, you can't see your customers. Emily is moving into new channels she never heard of 4 years ago, and now she's got to figure them out. Complex mixes. You have a high degree of own channels driving traffic. You all have a multi-stage journey where the outcome may be 4 steps removed from media. So you guys pick who goes first, but could you double click into some of these really meaty challenges and how you're dealing with them?
Yeah, if you don't mind, I'll jump right into what I talked about earlier and kind of teed up a bit is incrementality. So as we're thinking about channel measurement, our biggest problem is how incremental is each piece of content? What is it actually driving for the business? Which email drove that actual conversion? I mean, and the truth of it is, often it's the combination of them. So how the heck do you manage that? Especially for us, we're spending hundreds of millions of dollars in marketing every year. We're sending hundreds of millions of emails just about tax during tax season. So we run 6 billion model predictions in a day. That powers our marketing engine. We have all this stuff out in the world. How the heck do we measure what's working? So my personal approach here is it's all about the channel. So if you think about standard traditional click attribution, that was built for paid search. What is paid search but explicit intent, right? So that person comes in, tells you exactly what they want. You run an ad, they click on it. You are meeting their need. If they convert, that is a 1-to-1. You get full attribution. 100% of that value created came from that paid search ad. What if you're running a display banner? That person's probably already thinking about your brand. That's usually that either you're hitting them with an impression for some brand, or it's the 17th impression that helped drive that conversion, reminded them to do something they were already going to do. You have a broad spectrum of intent. So the incrementality on something like display, especially for, say, app display, is much lower. Well, how the heck do you measure this? You can come up with a really complicated multi-touch attribution model. You can do all sorts of stuff. What Credit Karma's done is we took a step back and said, okay, what are we trying to bias towards? What are our business objectives? We want to grow. Great. To grow in the market, you have to pay for impressions out in the wild. You have to get incremental folks in. So we are going to bias value being attributed back to our paid channels. We have a waterfall attribution methodology. So we give paid clicks 2 weeks. That's actually a really long window, right? And it will supersede the value created and the attribution on an email. Email only gets 1 day. So if somebody clicks on a paid ad and a week later then clicks on an email and converts, that paid ad actually gets the attribution for that value created, because we want to reinvest those dollars to get more incremental impressions out in the wild. It helps us feed this machine, this flywheel of marketing. So that's one piece, that we have this waterfall attribution to bias towards where we want to create incremental value. And then the next is at a channel level. We look at every channel, and we are constantly reevaluating incrementality. Like I said, paid search, super easy, one-to-one. You can run incrementality on that, and you're like, wow, that's 100%, fabulous. We've done the same for app networks. Some of them, when we run an incrementality test, you can do this if it's retargeting on your own member user base, meaning you hold off and say, I'm not going to target half of this audience. I'm going to run my ad to the other half. You look at those two audiences, their aggregate value created, and you say, all right, when I ran the ad, was there more value created? In app networks, it's about 40%. So we put a 40% multiplier. We said we get 0.4%, or 0.4 of this value created. If it's $100 of revenue generated, we only actually attribute back $40 of that to that paid ad, because it's a 40% incremental channel. So we're trying to be really thoughtful about where we're putting our dollars. And if you think about what that does, is that brings down the dollars you're investing in less incremental channels, and it lets you provide more dollars to more incremental channels. We've actually seen some social channels be over 100%. We are under attributing value. Let me give a great example of this. So we were trying to get into TikTok. You teed this up for me beautifully. We're breaking into new channels. We're trying to meet our members where they are. And the youth these days are spending their time on TikTok. I don't know, who in here has downloaded TikTok and spent some time there? Who here has lost too many hours of their life to that stinking platform? Yeah, it's really, really sticky. So what we found when we ran incrementality, or we just ran marketing, we didn't even run incrementality, we ran ads on TikTok. In standard app marketing, when we run an ad and someone clicks on it, over 80% of that traffic makes it to the landing page and it successfully loads. Like, you get some 20% drop off of people like, nah, I don't actually want to do this, but 80% is pretty good. When we dug into our funnel metrics on TikTok, which looked horrible from a return on ad spend perspective, we found that less than 30% of people were actually loading the landing page. So as folks were scrolling, seeing our ad, they'd click on it and say, oh God, you're taking me away from TikTok. No, 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 take me back. So we have to take a totally different approach to measurement on TikTok. We can't use click attribution because they're not clicking, they're not getting to the page. The click isn't going to result in trackable conversions. So we're starting to think about TikTok as more of an offline channel. In the same way we measure TV, radio, running geo-tests, thinking about it as offline impressions, knowing that the dynamic and interaction on this platform is completely different than other digital platforms. So this is the channel-by-channel analysis we run through to make sure that our media out in the world is driving maximum impact.
This is such a rich panel, and we'll be talking with Emily Moore. Looking at the clock, I want everyone to get airtime, so I'd love for you to dig in, and then I'll do speed round at the end, just audibling here. But I want you to make sure you got some great points to make.
Sure, yeah. So what's a little unique about so we have all those problems too, and I'd love to hear what you're saying about social media, because we're having that same discussion and we're kind of aiming in the same direction. But within the ETF space, there's like I think you said, there's a blinder in front of us. We're not able to really see the end conversion for our products. Exchange, we create the products, we distribute them into the marketplace, introduce them through an institutional partner called an authorized participant or a market maker. But once they're in the market, you know, Steve's trading with Mary and Mary's trading with John, and we don't get that information. The platforms that they trade on, whether it's Schwab or Fidelity or what have you, they all know the information, but of course they can't give us that information for privacy reasons, and because really we'd be looking for it for marketing reasons, and that's just not going to work. So we'd love to have that. Who actually bought the product? Can we track them either through third-party data or even first-party data to know whether or not we touched them? We can't. So we get some level of reporting from reporting services and so on, and we can get in directional information, but that's the frustrating part. We just don't know who the actual end buyer of that product is. As much as those of us that grew up in the mutual fund industry, there's a lot more data there, and you can see that, and who was the advisor that provided the services to the end buyer. So what we have to do is implement a lot of proxies to try to understand are our activities driving in the right direction. And so essentially what we're looking to do for our overall model is is find that sweet spot between activities that perform well, are effective, that are cost effective, and that doesn't necessarily mean cheap. I like inexpensive things at the top of the funnel. I'm willing to pay more for activities that are closer to the bottom of the funnel. But I want them to be as cost effective and feel good about that. And then lastly, of course, measurable. So we focus as much as we can on measurable. Now, back to the active trader. The attributes of active traders, the behavior of them is fairly well known, at least by us. We understand what they do. So what we like to do is focus a lot on mechanisms where we can key on those attributes. So we do a lot of programmatic media buy. Paid social media gives us all of that rich data to leverage as well. And we'll focus on those types of things. Our paid search is an enormous part of our budget because it's so intent-driven, and we have the ability to pull levers up and down when one particular asset class or segment is really what everyone's interested in right now. We'll let that budget rise, and we'll be taking from the asset classes where no one's interested at that point in time. So it's a fluid type of activity that we're doing. So what we're going to do is set up a model where we are looking at ultimate goal. If it hasn't been understood yet, we're trying to raise assets, right? So AUM is our ultimate goal, and we want to make sure that every one of our products has enough assets in it to justify its own existence. And so we're driving towards that. But we can't push a product that's not of interest at any point in time. So we have a whole process. Like I said, we have over 80 funds. We can't advertise or market all of them equally at all the time. So we have a process where we prioritize. We tier our products, and that dictates what type of amounts and types of advertising and marketing take place at any given point in time. Metrics-wise, we're looking at 3 real levels of metrics. Just the click attribution, all your traditional advertising metrics of impressions and clicks rates and cost per clicks as our starting point. Is the content or the assets that are out in the marketplace doing their job to generate interest? But then it's very important for us, so the proxy is really activity on our website. Are we getting the people interested enough to come to our site? Doesn't mean they're a buyer. We don't have a shopping cart on our website, unfortunately. We don't know if they are, but we can infer a lot of things by working a lot with Google Analytics and keying in on certain key events. Are they doing that? Essentially what we're trying to do there is drive towards the collection of first-party data. So we're looking for subscriptions, we're looking for people to form a digital relationship with us that's a little stickier. So that's where our content marketing comes into play. We want people signing up for the various different things that we have that they can use to track us. Active traders are very interested in other people's opinions and seeing what people are saying is moving at any point in time. That's the nature of our content marketing. So we're putting that in place. And then lastly, I have a dashboard system that will pull in all of the individual funds metrics. So number of accounts in a given ETF. I have the ability to get that information at least. I don't know who they are, but I know what the number is. So if we're dumping significant investment into a given product or set of products, we watch that over a period of time. Did we actually get more accounts built up in that actual product? One of the most key metrics there, I think. Shorter term metric is just looking at the volume. Are more people trading the product at any point in time? So we can look at that line item level, and then of course AUM. Creations and redemptions are another aspect of the ETF space that we'll look at. It's a little chunkier, but it's still a metric we'll do. So just to summarize that, we're looking at, are the assets performing well from a marketing or advertising standpoint? Are the people who became interested in them looking engaged by the activity that they're doing? And then ultimately, did it generate assets into the products? That's the model. It's the closest we can get. We think it's pretty good, but it requires, like I said earlier, a lot of attention to that on a regular basis to make sure that you're not sort of missing a trend that might be going on.
I definitely want to hear from Jeff. And not only have we solved all the attribution problems in the world, but apparently the fountain of youth. We have 10 more minutes than the last time.
I noticed that, yeah.
So relax and tell us the full story.
I have nothing else to say.
I do want to plus one something you said about
triangulating everything back to what is your actual business objective? And as marketing leaders, as marketers, always looking back at like, is my top line moving the way I think it is based on the channel attribution that I'm seeing, right? Because the worst thing in the world is to go into a meeting with your executives and be like, oh my gosh, we're crushing it on initiatives. Look at all this growth. And they're like, but the top line is down. What the hell is wrong with you? So you always want to be doing that triangulation, even if you have good attribution.
Those conversations are always a lot easier if the assets are moving in the right direction.
Yeah, exactly.
And then you have to get craftier if they aren't. So.
Well, so Jeff, you're a little unique from our other friends. Why don't you tell us a little bit?
Yeah,
about
I
what
mean,
you're doing?
just from a challenges perspective in creating an attribution model, there's a couple of things that, one I already mentioned is this cyclical nature of our transactions, right? Our best prospect is our best client. So, that's a challenge in and of itself. One, I'm sure is unique to us, getting people to enter things into things like Salesforce, right? I'm sure no one else has that issue out there. And I don't know why we can't do it. The transactional data we share with Andy, kind of while we on the mutual fund side have that, we also have an ETF side to our business where we have that. We have all the external factors that many of us have in our businesses. For us, it's the markets, right? How are the markets performing? How does that affect people's willingness to invest? The trends towards or away from our strongest products. Right, and in addition to that, how are our products performing? Right, that's a huge thing that it's pretty easy to market a top tier, 5-star, blowing the doors off fund. It's a little harder when it's maybe a more safe strategy that kind of consistently performs over time, but isn't that blow the doors off strategy. So a lot of challenges from our perspective in coming up how to measure the effectiveness of each marketing touch point.
And you mentioned a lot of your leads come from, this notion of paid, earned, owned, and even shared sponsorships. A lot of your leads are coming from owned channels. Are you able to measure those?
Yeah, I mean, I think, so our website on a monthly basis, 2/3 of the traffic, we're actually driving it. So, it's not people just like, hey, what's Hartford Funds up to, right? It's us driving them through our paid social media, through other paid channels, and importantly through our email efforts as well, which I mentioned earlier.
Well, I want to jump into the meat. What I found really remarkable about all you guys is I am sure you drive 1,000% of the revenue in the company, but you are also subject to exogenous factors like interest rates, defaults, the market, the stock market, economy, things like that. You also have to gather data from a lot of different places, mash it together, do some workarounds, and actually build a model. Why don't you get into the guts of how you're collecting that data, how you're running your models, and to what degree you have good measures coming out of them. I mean, because I found it very captivated. Some of you are buying models. You built an amazing model. You've got a different model. But why don't you dig into the depth there, and then we can circle back on some of the lighter things.
Yeah, well, I kind of explained the general model structure, but what I'll elaborate a little bit to say that so it's one thing to have the data and to have the dashboards, but it's how you react to that is what's most important. So what we do is actually have a bit of a committee that is formed to look at that on a monthly basis. Most of this is around that decision I talked about before. Where are we emphasizing our focus from a product level? Like what's getting the highest spend? It informs the content team because we're trying to put the right content out there at the right time. And we meet on that, like I said, a regular basis, monthly basis to assess. And by the way, we also invite onto that our capital markets team to give us the insight. What do we think is the trend? Because remember I said earlier, we're not looking to this isn't a news cycle marketing effort. We're not trying to talk about what's happening today, because we just can't do that with the compliance world we live in. But we are trying to see if we can figure out what do we think will be the prevailing asset class or asset classes to focus on over the next 2 to 3 months. And so we get that information, talk about it, kick the tires on it, and try to make those decisions, because we're trying to do a numbers game here, right? Like, yeah, we'll miss a blip in a particular small sector or something that went nuts for a couple of days or a week. nothing we can do about that really, but we want to make sure we're in the general areas, we're talking about that. And a lot of what we're trying to do is, with the marketing that we're doing and the content marketing that we're doing is really cross-selling. So there's a lot of people that use our products, they tend to use 1 to 4 of them.
Of 80.
Like I said, we have 80. So what we're trying to do is, hey, you were aware of our technology sector fund. But if really what you were after was trying to hone in on semiconductors that are doing very well in the technology sector, are you aware we actually have a semiconductors fund? So the breadth of product marketing is a big part of what we're trying to do as well. So anyway, so we're meeting on it. We're looking at the data that I described earlier, informing us around, are we on the beginning part of an uptrend or is that the tail? And how do we move that needle? And then that information gets decided upon and then pushed out to our media buying decisions, as well as our content team. And lately this year actually it hasn't been, the trends have all been very similar, right? It's been a tech-driven market. It's been the Magnificent Seven has been the prevailing story, and we have a lot of products that play well there. So we've only been doing slight little tacks over the last 6 to 9 months, which is always good from a kind of using your resources standpoint. But if that shifts, and it probably will, we just had a big news event a couple days ago, so that's probably going to drive some different things. And we'll make those changes and shift as we go. And if we're getting it right more than 50% of the time on those small decisions, I think we're probably doing pretty well. Of course, we strive for higher than that, but that's what it's all about. So I guess the message there, it is a lot of collaboration. You got to use all your resources as well as just the data that you compile to make your best decisions.
Jeff, you're like Nostradamus. You beat the 50. You can predict 50%. You said.
Yeah.
But a
little bit about
factors.
how we went about developing an attribution model. We worked with a professor at Northwestern University. Kind of gathered all our data from all our sources. So Marketo is our marketing automation platform, Salesforce, our transactional data, and we had them kind of pull together and look at it and try to come up with a way for us to indicate, with all the other factors and all the challenges from a sales cycle perspective I spoke to earlier, what really can drive things and where should we invest that next dollar from a marketing perspective. It told us a few things. First was the model can only explain about 50% of how money comes in the door at Hartford Funds. The other 50% is those factors I mentioned earlier, right? Things like the market, things like performance of a particular product, our great salespeople in the field, and the efforts that they make that maybe aren't in Salesforce, so we can't track them. The second thing was it uses a 6-week time frame. Basically, we can't tell after 6 weeks ago, we can't really say that something with certainty has an impact on a future sale. We know that that's not true. We know that marketing takes place over time, but in terms of assigning that real value, it took time. And the way it reads out to us is through elasticity. So if we grow an activity by 1% over time, what will that yield in terms of increased sales? It didn't. In some ways, the results were as expected, right? A salesperson meeting face-to-face with a financial advisor is a very high leverage opportunity. It's also one that's very difficult to scale, right? You can't just add salespeople endlessly. But things like email had real effects on our ability to engage. A little more difficult to measure things like paid search and some of the advertising things. That we saw positive attribution. But we also broke it down then based on the relationship that we have with that financial advisor. And we know that certain types of email work better with our core producers, right? The people that do a lot of business in a lot of different products. Other webinars, for instance, were indicated initially as a great way to get people in the door, right? With some of that value-added content that I think we both share. So it gave us a good way to understand where can we invest, and then we have to overlay the cost of those investments and figure out, where to, like I said, where to invest that next dollar. And it's something we update. We don't update it on a daily basis. It takes a lot of kind of firepower to do that. We update it a couple of times a year to see, okay, how has the changes we've been making from a marketing perspective, have we done something that has changed the effectiveness of one of our channels? Or, maybe there are new opportunities that we're not seeing.
You know, if I could just interject, since you're smart enough to work with professors from Northwestern, the guys at Wharton haven't figured this out, and you all mentioned this. To do this right, you guys are mastering and quantifying the response function, but the response function has an inflection point. Do any of you, does this curve flatten out, and do you know where the curve flattens out? Because you might get some false positives. As, let's hire 5,000 sales reps. They're causal of growth.
Yeah.
So the art of this is knowing this whole response function. Does the curve flatten out? Are you searching for that point, in these models, or is that just an unknown that neither Northwestern nor Wharton could figure out?
We're definitely searching for that point. I don't think our models explain that. We know that we can't. As effective as email might be, we can't send 15 emails a week to a financial advisor because they'll unsubscribe, right? Pretty simple.
So
Maybe you
there's
should
an argument
try.
still.
Little sample of, N of 5. Let's see what happens.
We definitely
Experimentation.
push the envelope as much as we can, but yeah, we look at other factors to try to figure out where is it becoming less effective.
Emily, you're super scientific. You've been talking about causal factors, leading indicators.
Yeah.
Why don't you dig in, and then I'll let you
Sure.
open it up.
I mean, first I have a couple questions. This is an interesting model that you worked with Northwestern on. Is this a media mix model, a actual channel attribution, multi-touch attribution model, or is it more of a benchmarking exercise on how effective is our marketing?
I think it's a combination of benchmarking and multi-touch attribution.
Okay.
Yeah.
Super interesting. And I'm actually deeply envious. We have the tech hubris of saying, well, we can figure it out ourselves. So we build everything in-house, grounds up. Like, we'll hire smart data scientists who don't come from a marketing background. So we have to build all this context. And how you find the inflection point of that marginal return curve or that marginal response curve is judgment. Right? It's understanding what is the cap of this channel. Sometimes it's a brand judgment. It's how many emails am I willing to send? Candidly, I do have a lot of opinions on email volume because if you run a short-term test, what we found is every time you send more email, it is more impactful for the business. We all know that will end long term.
Yeah.
So you have to take a longer time horizon in your test, right? You have to spread that out. We're going to do a 6-month experiment. We actually did this with tax season. We added on a ton of incremental emails. We're going to throw a holdout on this. We're going to see what happens. And we saw degradation in their response rates following tax season after we stopped those emails that did not go away. That response rate was gone forever. We would never have known that would have happened if we hadn't held that holdout and watched them for the 6 months after tax season. So we kind of have to pop our heads out and say, all right, if I'm going to use my best judgment, what do I think is actually going to happen here? If I'm measuring in-month revenue from email sends, oh my God, send more email. If I'm going to zoom out to the long-term health of the brand, the long-term health of the channel, we all know email deliverability is a thing, you have to think about it differently. So it's all judgment, right? You can be as scientific as you want, but if you're not using good judgment, you're going to miss something.
Well, Emily and I, this program is so great, are going to be talking more, and we're going to be talking about Gen Y, which is something no one understands, so super excited. Any questions, or do we have too many questions? I just want to make sure that if there's something burning, that we address it. I know this is pretty intense stuff, but I think it's relevant.
Who wants to talk about StatSig?
Yeah. Well, I'll tell you what I'm supposed to ask you is when they go back to their office and they want to get promoted or not screw up, what is your one piece of advice to them based on your hard-earned experience?
I mean, to me, it's compiling and knowing your data. Don't be able to not articulate at least as much as is available to articulate from the results of what you've done. So, and I think part of what you said is important, your point around the tax season campaign you had going on and then post. So it's important to understand both at the campaign level how things are going as well as is there an overall trend? Because it's really right message, right time to the right people, right? That's what we're talking about. So understand, you might have had a great campaign, but how are you doing as a whole? And is the whole, is the tide lowering altogether? So anyway, know your data, be able to articulate it as best as you can. And then I think to the point just a moment ago is have a rational, rationale around why you would recommend the next step, killing the campaign, going more all in, and so on. But be the student of what you do and be able to use that common sense and the numbers to articulate what your next best step is.
I think mine would be get your team right. I think having the right team for modern marketing is tough sometimes. I'm lucky enough to have a great team, and they understand kind of the modern aspect of marketing. We have a lot of people in our marketing organization that have been there a long time and still think of things the old way, and some of the topics that we've talked about today are really challenging. Having the right folks in place, empowering them to get after the real problems in your business, I think that's the best way to success for the team.
Which is a kind of a way of saying the world's changing, right? And so the talents that you need are probably different than they were 10 years ago. So
Love that team one. Yeah, for me, it's very much always be able to tie your activities to either a business strategy and goal or top-line business growth. If you can tell that story, you're off to the races. You're growing your team, you're growing your career, you're growing your impact, you're winning. If you can't make that direct line correlation of the work you're doing to business growth, everything gets harder.
Yeah, I gotta say, I've had a lot of hard knocks too, and doing the math, and it's a multi-step equation. Media changes preference, behavior, price sensitivity, consumption, which leads to future cash flow, margins, which leads to stock price. We wrote an equation in this book only because it's a must. I don't think it's a have to, it's a must have, and it's a multi-step equation. So, a lot of people got into marketing because it was their understanding there would be no math. And I can only emphasize, you gotta get that
I have a
math
degree in
right.
statistics, math helps.
Yeah. Hey, so Taisha, how many lifelines do I get as a co-chair? Because I was so focused on keeping up with these guys. What's coming next?
We've got speed networking. So when we wrap up the panel, we've got 15 minutes of speed networking before the next session.
And does that happen here?
Yeah,
or
exactly.
in here? Or
In here.
Okay. So, so my first screw up, or maybe my 8th screw up, who knows? But now we're doing speed networking. I think I'm supposed to remind you that an easy way to network is to use your app and your badge. And I think that's why we reminded you about that. This is really what it's all about. I mean, you're never going to get this many people in a room in a digital world. We'll see each other on Zoom calls for the next 100 years. So might as well get that human contact going. Thank you so much for the panel. That was great.
Hey,
Nice
great
work.
work.
That was great.